In a short time, digital currencies have gone from being novelty items to trillion-dollar technologies that have reshaped central banks and global economies. They cut costs and speed up transactions. They can eliminate third parties and use technologies like blind signatures and zero-knowledge proofs to increase privacy. But they can be volatile and are not accessible to all. Despite these challenges, digital money is here to stay. Cryptocurrencies such as Bitcoin are digital currencies that are decentralized and managed by peer-to-peer networks. These networks use cryptography, the encoding and decoding of information, to verify transactions. They also allow users to mint new coins and manage existing ones. Cryptocurrency prices fluctuate dramatically, making them a risky investment. In addition, their lack of regulation leaves them vulnerable to fraud, and they consume a staggering amount of energy in the process of mining them. The rapid rise of cryptocurrencies and decentralized finance, DeFi enterprises, has forced regulators to begin crafting rules for the sector. If they become the dominant form of global payments, cryptocurrencies could limit central banks' ability to set monetary policy through control of the money supply. They could also be used to evade taxes and launder money. Finally, the largely anonymous nature of cryptocurrency systems raises concerns about their role in the criminal economy. Despite the controversy, cryptocurrencies have proven popular with some consumers. A survey by the Pew Research Center found that 16% of Americans say they have invested in, traded, or used cryptocurrency. The speed and ease of using cryptocurrencies is appealing to many. Unlike bank transfers, which can take up to 5 days, transferring value using crypto is almost instant. Additionally, the cost of sending a cryptocurrency can be low or even free. While many people use cryptocurrencies to purchase goods and services, the most common use is speculation. Many investors buy and sell cryptocurrencies to make profits. They are not widely accepted as a means of payment, however. Cryptocurrencies also do not provide the same consumer protections as traditional financial products, such as credit cards. Some cryptocurrencies have been exploited by criminals to carry out ransomware attacks, where hackers hold a victim's computer hostage until the user pays a ransom. Others have been used to fund terrorist and rogue state activities. The lack of regulation and high volatility have also raised concerns about cryptocurrencies' potential to disrupt the global financial system. The future of cryptocurrencies will likely be determined by how quickly regulators can develop rules to protect consumers and foster innovation. Central bank digital currencies. Digital disruptions have shaken up the financial services industry. Cryptocurrencies and blockchain technology have lowered transaction costs, improved security, and offered new ways to make payments. These innovations have made people rethink their relationship with money, causing banks and central banks to remodel their systems for the digital age. One new way that they're doing this is by exploring central bank digital currencies, or CBDCs. These are electronic forms of a country's currency, backed by the full faith and credit of the government, that would replace physical cash and coins. Currently, over 90% of the world's money is in the form of cash and coins. But digital transactions are increasing, and the COVID-19 pandemic has accelerated a shift towards contactless payments, e-commerce, and other forms of digital currency. A CBDC could be designed for retail use, like a digital version of the British pound, or used between financial institutions to settle payments and trades, a wholesale CBDC. Alternatively, it might be used in monetary policy operations, such as when a central bank needs to intervene in markets. The idea behind CBDCs is to promote financial inclusion and provide a safe, risk-free entry point into the formal financial system. They may also offer lower transaction costs and more transparency than traditional bank transfers, but the benefits could be different for each country, depending on their economic conditions and goals. It's still early days for CBDCs, which might be several years before they become widely adopted. Nevertheless, the interest in them is growing. A survey conducted by the BIS in 2021 found that 86% of central banks were actively researching them, and 60% were experimenting with them or running pilot projects. The growth of CBDCs highlights the potential impact of technology on our lives and the economy. These new digital currencies have the potential to improve financial inclusion by providing easier and cheaper access to money for millions of people who might otherwise be excluded from the banking system, increase competition and resilience in the domestic payment market, reduce transaction costs and boost efficiency, and allow for programmable money. Stablecoins are a new breed of cryptocurrency that seek to offer more stability than Bitcoin and other volatile cryptos. They are pegged to the value of a fiat currency such as the US dollar or a commodity such as gold. The idea is that stablecoins can be used just like traditional electronic money, allowing you to buy and sell things online without worrying about the price jumping up and down. The major difference is that instead of relying on paper money as backing, they use blockchain technology to store the coin's value. While many people see the stability of stablecoins as an attractive selling point, there are some risks that must be considered before purchasing them. The main risk is that the company that issues a stablecoin could run into financial problems, resulting in a loss of value for those who hold the coins. Other potential risks include hacking and user error. There are also concerns that stablecoins could be used to launder funds or to fund criminal activity. Regulatory uncertainty has also been a concern for the growing market for stablecoins. For example, some lawmakers are calling for the creation of laws that would treat stablecoin issuers like banks and would require them to conduct regular audits of their reserve assets. Others are pushing for regulations similar to that of virtual currencies, such as those provided by the CFTC and SEC. For most investors, the best way to minimize the risk of losing money on a stablecoin is to choose one that is backed by a large bank or other established financial institution. This helps to ensure that there are enough funds available to redeem the coins if they lose value. In addition, some stablecoins are backed by real assets such as short-term treasuries or cash equivalents, which add another layer of protection to the investment. For example, Tether claims to have reserves equal to the value of its USDT stablecoin, which is a big selling point for some buyers. But there is a risk that Tether could lose its status as a trusted stablecoin, leading to a drop in the coin's value. Mobile money. The use of mobile phones for banking and payments is becoming an integral part of everyday life in many parts of the world. According to GSMA, there are more than 1.6 billion registered mobile money accounts worldwide, and the value of transactions on these platforms increased by 22% in 2022. These transactions are used to transfer money, save, pay bills, and purchase products and services. The popularity of mobile payment systems is fueling the growth of the financial inclusion sector. One of the main benefits of mobile money is that it enables people to store and move their own funds without the need for third parties. It can also reduce the cost of transactions and improve business efficiency. This is particularly important for the 1.7 billion adults who lack a bank or mobile money account and rely on cash in their day-to-day activities. Mobile money can help them get on the digital economy ladder and provide a link to mainstream financial services such as deposits and loans. Aside from its monetary functions, mobile money is also transforming daily lives in rural and urban areas by providing practical and life-enhancing services. These include cash transfers to family and friends, savings through a network or individually, microcredit for businesses, and crowdfunding in disaster response. In addition, the use of mobile money facilitates more efficient trade and better labor market outcomes. These changes in financial behavior have also improved people's resilience to shocks. Mobile money has become a powerful tool for economic development in low and middle-income countries, LMICs. It has enabled people to save, access microcredit, and participate in digital agricultural credit and humanitarian cash transfer programs. These programs have been effective in reducing poverty and promoting prosperity. This paper uses a combination of econometric and qualitative data to explore how the use of mobile money relates to human development. The study was conducted in Kajiado County, Kenya, a remote region in the outskirts of Nairobi. The research was based on ethnographic observations and interviews with mobile money users and service providers. The analytical framework was the capability approach, which focuses on understanding how individuals construct meanings and experiences through their interactions with different aspects of a phenomenon. This approach is appropriate for this type of study, as it emphasizes that knowledge is socially constructed and subject to interpretation.